Most traders fail not because the market is unbeatable, but because they're chasing signals without understanding where smart money is actually moving. What if I told you there's a model that combines the three most powerful ICT concepts, liquidity grabs, order blocks, and fair value gaps, into one complete strategy for finding high-probability setups? In this video, I'm going to break down exactly how to use these tools together, step by step, so you can stop guessing and start trading with precision. By the end, you'll see how this model gives you a clear roadmap for spotting where price is most likely to react, and how to position yourself with the institutions, not against them. Alright, let's dive in. This strategy is built on two main elements, a liquidity sweep and a fair value gap. When combined, they form a high probability setup that works in both trending directions, bullish or bearish. In a bullish case, the pattern shows up when price revisits an area where sell-side liquidity has already been taken out, like the lows of the demand zone, a significant swing low, or equal lows. After liquidity is cleared, price often rejects cleanly from that zone. When price taps into the order block created by the sweep, it commonly flips direction aggressively and continues higher, aligning with the bullish trend. In bearish conditions, the exact same logic applies, but in the opposite direction, targeting buy-side liquidity before continuing downward. In this scenario, the setup unfolds when price returns to an area where buy-side liquidity has already been taken out, for example, the highs of a supply zone or a group of equal highs. A sharp rejection from that level usually signals the start of a downward move, confirming that the bearish trend is still intact. So, why is this setup so effective? The reasoning is straightforward but powerful. Smart money often drives price into critical zones to create liquidity and trick retail traders, building enough volume to place large institutional orders. Typically, this manipulation happens with a sudden push above or below a key level, immediately followed by a strong reversal in the opposite direction. These areas mark the first entries of smart money, manipulation zones formed just before big institutional orders hit the market. That's why they hold so much significance, and why price so often reacts to them with precision. When price returns to these zones, institutions often re-enter to protect their positions or to complete the rest of their orders. That's the exact reason we wait for price to revisit these levels. It's where the strongest reactions tend to happen. To maximize the effectiveness of this strategy, you'll want to use a two-timeframe approach. Start with a higher timeframe to gauge overall market conditions and to spot liquidity sweeps along with the order blocks connected to them. The 30-minute and 15-minute charts are the most reliable for this stage. Once you've spotted a potential setup, shift to a lower timeframe, like the 5-minute or even the 1-minute chart, to look for confirmation and pinpoint entry signals. Here's the structure. If you're analyzing on the 30-minute chart, drop down to the 5-minute for confirmation and entries. If you're working with the 15-minute chart, zoom into the 1-minute for precision. The strength of this model is its flexibility. It performs well in both cases. The key is choosing the timeframe combo that matches your trading style and applying it consistently. In a bullish setup, the first thing you want to do is look for a clear liquidity sweep on a higher timeframe, such as the 30-minute or 15-minute chart. What you're watching for is price running through an important level, quickly reversing, and then confirming that move with a break of structure. Once this sequence is in place, the next step is to highlight the order block that was responsible for both the liquidity grab and the break of structure. That higher time frame order block becomes your main point of interest. Most of the time, price will come back to revisit it, and when it does, it often acts as a demand zone where institutional money steps back into the market. After marking out the block, your job is to simply wait for price to retrace into it. That's where the trading opportunity usually develops. Now, when price taps back into the block, you've got two possible entry styles, conservative and aggressive. Let's walk through the conservative approach first. Once price reaches the higher time frame order block, we drop down to a lower time frame, like the 5-minute or even the 1-minute, and watch for signs of reversal. This could show up as a market structure shift or a clear change of character, which gives us that first layer of confirmation. When that shift confirms and we anticipate price moving higher, the next step is to identify a bullish fair value gap that forms inside that structure shift leg. These imbalances often act like magnets, drawing price back before it continues in the intended direction. To execute, we can place a buy limit order around the midpoint, the 50% level, of the bullish fair value gap on the lower time frame. For targets, we aim at the higher time frame buy-side liquidity. That way, the setup is not only precise but also carries strong probability in our favor. Now let's talk about the second method, the aggressive entry. In this approach, once price taps into the higher time frame order block, we again shift down to the lower time frame. But this time, instead of waiting for a full structure shift, we're focusing on something a little different, a fair value gap that gets violated and then flips into what we call an inverse fair value gap. That becomes our first key confirmation. When this inverse fair value gap forms, it often acts as fresh support, creating a strong area for a potential buy entry. If, at the same time, we also spot a market structure shift, that adds another powerful layer of confluence, making the setup even stronger. With these conditions in place, we then anticipate price pulling back into the inverse fair value gap before continuing higher, aiming for the next area of buy-side liquidity. At this point, the execution is simple. You'd place a buy limit order around the midpoint of the newly formed inverse fair value gap, with your take profit set at the nearest higher time frame buy-side liquidity. The same framework works in a bearish scenario as well, just in the opposite direction. Here's a useful tip: if you're trading with the 30-minute and 5-minute time frame combination, both the conservative and aggressive entries tend to perform well. But if you're working with the 15-minute and 1-minute combination, the aggressive entry method usually delivers stronger results. Now let's bring it all together with a real chart example so you can see how this strategy actually plays out. On the screen, we've got the gold 1-hour chart. Notice how price sweeps the sell-side liquidity resting below this 1-hour swing low, then immediately snaps back into the bullish trend, shifting direction and pushing higher. If we drop down to the 15-minute chart for a closer look, the picture becomes even clearer. After the liquidity sweep, price not only reversed but also confirmed the move with a bullish break of structure by closing above the most recent swing high. So here, we've got the full checklist: a clean liquidity sweep, a sharp reversal, and a confirmed break of structure on the 15-minute chart, exactly the ingredients we were waiting for. The next step is to track down the origin of this bullish expansion, the exact move that created both the liquidity sweep and the break of structure. To do that, we highlight the down close candle, the opposite color candle, which forms the 15-minute order block. This is the key spot with the potential to reverse price. That leaves us with a fresh, unmitigated demand zone, and this is exactly where we want to stay focused. It's the ideal area to look for long setups if price makes its way back down. Once we've identified the higher time frame order block, the plan is simple: wait for price to retrace and tap into it. Let's roll the chart forward and see what happens. As you can see, price drives lower, tags the zone, and immediately shows signs of rejection. Next, I zoom into the lower time frame, in this case, the 1-minute chart, to carefully watch how price reacts inside that 15-minute order block zone. What I'm looking for here are signs of reversal and a clean entry point for a long trade. On the 1-minute chart, you can see that after touching the 15-minute order block, the price reacted, but so far it has not given us an entry point, because it couldn't break above the previous swing highs. So, we wait and let the market give us the entry. In the next move, price returns again to the previous low, and we expect that if it wants to go lower, then it should hold this FVG. After that, on the 1-minute chart, price gave us a market structure shift, and since it couldn't hold the bearish FVG and created a new FVG in line with that, this area becomes valid. The next step is to pinpoint the actual entry. If you look closely, you'll notice that price forms a bullish fair value gap and an IFVG within the structure shift leg. These imbalances often attract price back before it continues in the intended direction. With all our rules aligned, I'm taking the conservative. Of course, the aggressive entry and the conservative entry have overlapped. entry here, placing a buy limit order at the midpoint of that 1-minute bullish fair value gap, with my take profit set at the most recent 15-minute buy-side liquidity. Now let's play the chart forward. As you can see, the long entry is triggered, price flips direction, pushes higher just as anticipated, and eventually hits the target. Now let's move on to the next real chart example. On the screen, we've got the Euro to US dollar 30-minute chart. Notice how price sweeps the buy-side liquidity sitting above this swing high, then immediately shifts direction, dropping back below the swing high's range and driving lower. If you look closely, you'll see that after the liquidity sweep, price also confirmed a bearish break of structure by breaking and closing beneath the most recent swing low. So once again, we've got all the elements we were waiting for: a valid liquidity sweep, a sharp reversal in the opposite direction, and a clean market structure shift on the 30-minute chart. Next, I'm going to mark out the 30-minute order block as our key point of interest, specifically this last up-close candle just before price initiated the bearish expansion. That creates a fresh, unmitigated supply zone, and this is exactly where we want to focus. It's the ideal area to look for short opportunities if price retraces back into it. Once we've identified this higher time frame supply zone, the next step is simple: wait for price to tap into it. Let's roll the chart forward. As you can see, price pushes higher, tags the 30-minute supply zone, and immediately begins to reject. Now I drop down to the 5-minute chart to study the reaction inside the zone. Here's what stands out. Once price tapped into supply, it not only rejected but also broke through a bullish fair value gap, flipping it into an inverse fair value gap. That new IFVG is now likely to act as resistance, giving us a clean entry point for a short position. From here, the expectation is straightforward. Price should retrace back into the inverse fair value gap before continuing lower. With all the rules lining up, I'm taking the aggressive entry. I've set a sell limit order at the midpoint of that 5-minute bearish IFVG, with my target placed at the swing low formed just beneath it. Now let's play the chart forward. As you can see, price makes a small push higher, triggers the short entry, then quickly reverses direction and sells off with strong bearish momentum, cleanly hitting our take profit target. That's it, traders. I hope you found this breakdown helpful. If you enjoyed the video, don't forget to hit subscribe and turn on notifications so you don't miss future updates. Drop a comment below with your thoughts or any topics you'd like me to cover next. Thanks for the support, and I'll see you in the next video.